Did we just enter the dot-com 2.0? That's the chilling question coming from the International Monetary Fund this week as they issue their gravest warning yet about the soaring valuations of AI stocks. The tech market is currently valued at levels not seen since the year 2000, and for the first time, the IMF is explicitly calling out the risk of a sharp market repricing if AI fails to deliver on its incredibly lofty promises. So, we're diving deep into the data. Is the IMF right? Are your AI investments on the edge of a cliff? This is everything you need to know. Let's dive in. AI has become the heartbeat of global markets. From Silicon Valley to Seoul, from Wall Street to London, investors are betting that artificial intelligence will redefine productivity and profits for the next decade. In 2024 alone, AI-related investments surged past $400 billion, according to industry trackers. U.S. household wealth linked to AI stocks ballooned by nearly $5 trillion, largely driven by giants like NVIDIA, Microsoft, and Apple. But the IMF now sees worrying parallels with the late 1990s, when the promise of the internet led to inflated valuations, unrealistic expectations, and eventually a painful collapse. As IMF chief economist Pierre-Olivier Gourinchas put it, stock valuations in AI are approaching the levels of exuberance we saw during the dot-com boom. And history reminds us how quickly optimism can turn into fear. The IMF's latest Global Financial Stability Report draws attention to one number: valuation concentration. Today, just 7 companies, NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, and Broadcom, now account for nearly 1/3 of the entire S&P 500's value. That's the highest concentration ever recorded in modern U.S. market history. These companies are delivering massive profits, yes, but the IMF warns that investor sentiment may have run ahead of earnings growth. In its report, the fund compared AI's investment surge to the dot-com era. Back then, technology investment as a share of GDP peaked at around 1.2%. Today, AI stands at 0.4%, lower but rising exponentially. The curve looks eerily similar. Meanwhile, venture capital funding in AI startups jumped 400% in 2 years, with some valuations growing tenfold before generating $1 of revenue. For the IMF, these aren't just numbers, they're signals. Signals that expectations may no longer match fundamentals. Interestingly, the IMF isn't calling for a global meltdown. Unlike the dot-com bubble, much of today's AI investment is financed through corporate cash reserves, not borrowed money. That means there's less leverage, fewer risky loans, or complex derivatives tied to AI stocks. So even if prices fall sharply, the risk of a systemic financial crisis, the kind that spreads through banks, remains relatively low. In other words, the IMF is saying a correction is likely, a collapse is not. That distinction matters. It means the pain could be concentrated among equity investors and speculative funds, not the banking system. But even without a financial crisis, a sharp market correction could still ripple through global economies, cutting household wealth, slowing tech investment, and triggering layoffs across the AI supply chain. The IMF isn't the only one. The Bank of England's Financial Policy Committee issued a similar statement this week, warning that valuations in AI-linked stocks are stretched to levels not seen since 2000. Their concern isn't just about price, it's about expectation. Governments, corporations, and investors are all banking on AI to drive extraordinary productivity growth. But there's growing uncertainty about how soon, or even whether, that productivity will materialize. Former Meta executive Nick Clegg recently said in an interview that AI has entered a phase of speculative overconfidence, much like social media did in 2012. And on social media platform X, traders have started using the hashtag AI bubble to describe wild price moves in AI chip and cloud infrastructure stocks. Meanwhile, analysts note that behind the flashy valuations, the AI industry faces real constraints: power shortages, limited chip supply, and skyrocketing data center costs that could cap near-term profitability. But here's where the debate gets interesting. For every warning, there's a counter-argument, and it's not without merit. Analysts from Goldman Sachs and UBS argue that this time it's different. Unlike the dot-com boom, AI leaders today are already showing substantial earnings. Microsoft's AI integrations in Office 365 have generated billions in new subscription revenue. NVIDIA's data center division alone is producing profit margins above 75%. And Amazon's AWS AI offerings are expected to cross $10 billion in this fiscal year. Goldman's Mike Washington summed it up well. If these companies are growing earnings at 30% a year, calling it a bubble might just be a lazy analysis. Even the IMF acknowledges that the fundamental promise of AI remains strong. It's not the technology that's risky, but the speed of speculation around it. Still, history teaches us that bubbles don't burst simply because things are overvalued. They burst when confidence cracks. There are several possible triggers: a disappointing earnings season from major AI firms, rising energy costs pushing up data center expenses, or a sudden shift in regulation, particularly around privacy, data use, or AI-generated content. IMF Managing Director Kristalina Georgieva cautioned that many countries still lack proper ethical and regulatory foundations for AI. Without them, trust can evaporate quickly, and with it, investor confidence. And when confidence breaks in markets this concentrated, history shows that losses can cascade fast. So who's right? The cautious economists or the confident investors? The truth lies likely somewhere in between. Yes, AI's potential is real, but the pace of investment has clearly outstripped what's been commercially realized so far. If AI delivers even half of its expected productivity boost, the market's optimism could be justified. If not, the correction could be swift and painful, though likely contained. The IMF isn't trying to kill optimism. It's trying to inject realism, to remind investors that even revolutionary technology follows economic gravity. The story of AI and finance is ultimately one of balance between innovation and speculation, belief and evidence. The warnings from the IMF and others don't mean AI's future is in doubt. They mean that the way we invest in that future needs more discipline, more data, and a little less euphoria. Because as history shows, the line between a technological revolution and a financial bubble is only clear after it bursts. So we track these critical financial headlines every single day. If this deep dive helped you navigate the AI market, hit the like button and subscribe to join our community. Now, the big question for you is, do you agree with the IMF's bubble warning, or is this just healthy growth? Let us know in the comments below.